Assalamualaikum warahmatullahi and good day to everyone. This video presentation is a supplement to the video presentation on impairment of financial assets by your colleagues earlier. For this short presentation, I will be touching on how the new model of impairment for financial assets came to being under IFRS 9. I will also highlight a few things on general approach and simplified approach and offsetting. Your colleagues have done quite an extensive work on presenting impairment on financial assets, which leave me with few minor things to discuss here. But before we start, I would like to give credit to EY on their applying IFRS series, specifically for impairment of financial instruments under IFRS 9, published April 2018, and IFRS Community on impairment of financial assets under IFRS 9, updated May 2020. For the classification and measurement of financial assets, your colleagues have discussed it extensively, thus I am not going to go into this at all, but I will jump directly into impairment. To start our conversation on impairment of financial assets, I want to bring you back to the events that called for the new model, the Great Financial Crisis in 2008. But of course it started long before 2008. I have shared in Putra Blast some of the videos that you may want to watch to bring you back to that period of financial disaster and help you understand the crisis. For now, just imagine that you have invested all your savings in a portfolio managed by an institution. And the investment was made on financial assets, certificates that promise you a much higher amount in the future, say valued at 100 billion ringgit overall. Now, having such investment and future income, you started to make plans. What you are going to do with the money. Perhaps every night before going to bed, you will be planning and calculating. But what if the next morning you got a call from the manager saying that you lost everything that you have invested? There's no money coming in, sealed, not even your principal. All of a sudden, the promises made cannot be fulfilled, and you are left with nothing. Now imagine the institution as banks. With such bad investments, just like during the time of the Great Depression in 1930s in the US, people were panicking and withdrawing whatever they have left from their accounts, and all of a sudden banks have no money to recycle. They had to file for bankruptcy, employees had to be made redundant, and the rest is history. In the case of 2008 financial crisis, the financial assets that they were investing in were the mortgage-backed securities, financial instruments that are not backed by real asset, but by the promises of people paying for their housing loans, given in abundance to those people that the banks knew very well will not be able to pay back their loans. Greed blinded their sanity and rationale. But that is how interest works. The longer you delay payment, the greater the amounts of interest you need to pay. Thus, banks were the ones causing such a huge, not just financial, but also humanitarian crisis. And that escalated to a global crisis, as we are now living in a pretty much borderless economy. As we have learned in earlier FAR courses, an asset depends on its future economic benefits. So long as the benefit exists, we recognize them as assets. And even when we assess for impairment, that is a significant reduction in the asset's value, we will be looking for the indications that tells us, yes, the value will be much lower in the future, based on what has happened. In the events of the crisis, we were not looking forward, but we looked at historical data, and we waited for significant event to occur before recognizing impairment. Well, by the time the event happened, it is a little too late. Nothing can be saved. This resulted in a huge financial shock. After the start of the economic crisis in 2008, ISB decided to issue IFRS 9 with a particular attention to classification and measurements of financial instruments. The ISB published the final versions of IFRS 9 in July 2014, replacing IAS 39. The main new features include a new model of classification and measurement, impairment, hedge accounting, and own credit. and the new model of impairment is structured in such a way to avoid the huge financial shock in the future. In short, what we are seeing in the new model is that we are recognizing expected loss rather than incurred loss. And to recognize this expected loss, we do not need to wait for any loss event that trigger impairment to occur. We are forced to analyze even on day one of acquiring the financial assets of any possibilities for expected future loss due to any probable future events that may trigger it. And this is what we term as forward-looking expected loss. The good thing about this is the shock, if any, would be minimized and not abrupt, as we gradually reducing the value of the financial assets by recognizing the expected future loss, or termed as expected credit loss, ECL. If at the end of the instrument period we ended up with a much higher realized value, that would be a pleasant surprise. If the value is lower, we would say we are not surprised. For the ECL, we need to, at minimum, recognize a 12-month expected future loss, that is for a low credit risk. If the risk is not low, we are required to recognize not only 12 months ECL, but a lifetime ECL, that is the lifetime of the financial asset. Your colleagues have also discussed in a great length about the three approaches of impairment for financial assets. I will not, therefore, discuss any of them in this video, but I would like to highlight certain things that need some attention. Basically, under general approach, we have something like this. We need to assess whether the financial asset belongs to stage 1, stage 2, or stage 3 of credit risk. We need to decide whether the increase in credit risk year after year is significant enough for the financial asset to be transferred to stage 2 or stage 3. If yes, then we need to recognize not 12 months ECL but lifetime ECL. What the standard does not specify is what significant means. Therefore, entities need to exercise judgment and develop their own criteria. But they have good reasons for not specifying how much is considered as significant. In their basis of conclusions, or BC document, the standard states that if they specify a fixed percentage change in the risk of default, it will require entities to use the risk of default approach, which not all entities use, and doing it will increase the costs and effort for those entities not using such approach. If they define the amount of change in the risk of default occurring, that would be arbitrary and would depend on the type of products, maturities, and initial credit risks. Instead, the standard emphasized that the determinations of significance of the change in the risk of a default occurring depends on two things. First, the original credit risk at initial recognition. By this, we anticipate that those with a much lower initial credit risk would have a more significant change rather than those with higher initial credit risk. Second, it depends on the expected life or term structure. By this, we expect that the risk of a default occurring for financial instruments with similar credit risk increases the longer the expected life of the financial instruments. Therefore, if the risk of a default occurring for a financial instrument with an expected life of 10 years at initial recognition is the same after 5 years, then this indicates that the credit risk has increased, given the shorter term left. Therefore, we cannot simply compare the absolute risk. Similarly, the standard also cautioned that given a shorter term left to maturity, it does not necessarily mean that the risk of default has decreased. Therefore, entities need to also consider other qualitative factors. You may want to refer to the appendix in the standard, in particular, Appendix B 5.5.17 for a non-exhaustive list of information that may be relevant in assessing changes in credit risk. This is just another way of looking at the 3 stages. Stage 1 refers to low credit risk instruments, while Stage 2 and Stage 3 refers to instruments with credit risk higher than low. In practice, an entity may assume that the credit risk on a financial instrument has not increased significantly since initial recognition if the financial instrument is determined to have low credit risk at the reporting date. You may refer to paragraph 5.5.10 for this provision and Appendix B.5.5.22 to 24 that elaborate on when an asset can be considered to have low credit risk. Another thing that I would like to highlight is the term default. The standard does not define the term default. Instead, it requires an entity to apply a default definition that is consistent with the definition used in its own firm for internal credit risk management purposes for the relevant financial instrument and consider qualitative indicators when appropriate. However, the standard introduces a rebuttable presumption that default does not occur later than when a financial asset is 90 days past due, unless an entity has reasonable and supportable information to demonstrate that a more lagging default criterion is more appropriate. In the end, to apply a general approach of impairment, assessment should be done at each reporting date. It must be based on reasonable and supportable information at the reporting date about not only past events but also current conditions and future economic conditions. It shall be done at individual instruments level or a collection of instruments. An entity shall develop its own policies to determine the significant increase in credit risk. An ECL shall be recognized from the point at which the financial asset is originated or acquired, which refers to day one loss. As mentioned by your colleagues in their presentation, a simplified approach impairment is suitable for non-financial entities because they do not deal with financial instruments on a regular basis, therefore do not require sophisticated credit risk management system. Consequently, it is suitable for financial assets such as trade receivables and contracts with no significant financing components. This simplified approach is also known as loss rate approach. In practice, for such financial assets, we use provision metrics. Basically, what we do is we segment all receivables according to its credit loss pattern. For example, customer type, geographical locations, type of collateral, and so on. Then we set the aging for them, such as those not past due, those past due 1 to 30 days, past due 31 to 60 days, and past due 90 or more days. Then we work on the historical data of these financial assets to calculate the loss rate, and this will be the starting point of an estimated loss rate for the future. Historical data may be adjusted to take into account reasonable and supportable information that is available without due cost or effort at the reporting date about the current conditions and forecasts of future economic condition. Thus, perhaps we may also adjust the loss rate. For an example of a provision matrix, let us look at this illustration. This is the historical data of a firm for the month of January for its sales. For this segment, it is assumed that sales are usually made on credit, therefore it has a significant balance of trade receivables outstanding at each reporting date. As there is no significant financing component, it recognizes lifetime ECL for all its trade receivables. In real life, The loss rate should be based on data from several months, but it cannot be too old, as it may yield outdated results. The receivables are presented based on the receivables aging that are not overdue, overdue 1 to 30 days, overdue 31 to 60 days, overdue 61 to 90 days, and overdue 91 days or more, or even not paid at all. And then, based on historical data, adjusted to the current conditions and future economic conditions, we calculate and determine the loss rate. How do we do this? Is by looking at the very end. We have an actual loss of 2,000 ringgit of debt not being paid. Thus, at that point, it is 100% loss, that is 2,000 ringgit over 2,000 ringgit. This 2,000 ringgit is equivalent to 2% of the total initial amounts of debt at 100,000 ringgit, and is equivalent to 4% of the total amount due after 30 days, and is equivalent to 9% of the total amount due after 60 days, and is equivalent to 25% of the total amount due after 90 days. So by analyzing the pattern, we have calculated the loss rate. Basically, we are saying at the very beginning, when the sales were made, we expect a loss of 2%. After 30 days, whatever amount left unpaid, we will be expecting a loss of 4% in the end. After 60 days, whatever amount left unpaid, we will be expecting a loss of 9% in the end. And after 90 days, whatever amount left unpaid, we will be expecting a loss of 25% in the end. Assuming that, taking into account the current conditions and future economic conditions, the loss rate has not changed. We can now apply the loss rate to the current receivables at the reporting date as shown here, and calculate the lifetime ECL by multiplying the loss rate with the amount relevant to the specific aging group, bearing in mind that amount paid and unpaid after certain days are also estimation. For offsetting, there is nothing much to add to the discussion by your colleague, but I simply would like to share what offsetting means. It can mean that an entity having both financial asset and financial liability in another entity offset the two balances and end up with a net amount that results in either financial asset if it is favorable and financial liability if it is not favorable. Offsetting can also apply to an entity having multiple accounts in a bank with balances of both debit and credit. Thus, offsetting it will result again either in a debit balance where the entity owed the bank, or a credit balance where the entity ends up having positive balance in the bank. Offsetting can also apply in a situation involving three parties, where one of them having financial asset in one entity and financial liability in the other entity, and all of them agreed to offset the balances. One thing to remember is that it requires written legal contract in order for it to be allowed. Further guideline on offsetting can be found in the appendix of the standard as shown here. I have to say that the discussion on impairment of financial asset has been done thoroughly by your colleagues, and you should even refer to the forum for questions and answers, since the questions asked are all as good as the answers given. Please check it out when you want to revise this topic later. That is all about impairment that I would like to add. Thank you very much for watching, and I will see you again in the next one, inshallah. Wassalamualaikum warahmatullahi wabarakatuh.